Hey guys, welcome back to another episode. In this video I'm revealing a simple pullback confluence strategy that will change the way you trade. So without further ado, let's get on with the video. First, let's start with the basics. What is a pullback exactly? A pullback refers to a temporary counter move in the price of an asset within an established trend. It is a short-term reversal against the prevailing direction before the trend resumes. And so why is it so important to understand? Let me give you an example. You can see that the current market is going up and you want to buy. But as an experienced trader, you know that trends rarely move straight up without any interruptions. In fact, most trends look like this. The price goes up, then it pulls back, and then it goes up again. So, if you enter a buy position when the price is going up, there's a possibility that it might pull back or even reverse the trend. Instead of taking that risk, it's safer to wait for a pullback in the trend before entering a position. This way, you are buying into the trend with lower risk involved. You might wonder how to determine if a pullback will end or continue moving downwards. Based on my research, I have identified 3 common levels where pullbacks tend to find support and reverse. Let's start with the first level, which is support and resistance. Let me illustrate this with an example. If we look to the left, we can see that the price was repeatedly rejected at this level, indicating a resistance area. Eventually, the price broke out of the resistance and started a pullback. Now, pay attention to where the pullback ended. It found support at the previous resistance level, which now acts as a support level. The price then continued its upward movement, experienced another pullback, and where did the pullback ended, the previous resistance now turned support. This same concept applies to downtrends as well. Now, let's move on to explore further. The next level where pullbacks often occur is the trend line. In this chart, we identified a downtrend, so we placed a trend line above it because the price was repeatedly rejected at that level. Now, pay attention to the price movement. It made a pullback towards the trend line and then moved downward. It pulled back towards the trend line again and continued to go down. This example demonstrates a pullback towards a trend line. Another level where the market may potentially experience a pullback is the moving average. In this scenario, we identified an uptrend, and we decided to use the 50-period moving average as our key level. It's important to note that for this specific example, we are using the 50-period moving average because it has shown significant market reaction in the past. However, markets can also react to other periods such as the 20, 100, or 200-period moving averages. Therefore, it's crucial to adjust accordingly based on what the market is responding to. As you can observe, the price made a pullback towards the moving average and then continued to trade higher. It pulled back towards the moving average once again and continued its upward trajectory. This serves as an example of the price pulling back towards the moving average. In some instances, you may come across charts that have multiple levels interacting with each other. Take this example, where we have applied the 50-period moving average, and the price pulls back towards it. However, what's interesting to note is that there's also a level of trend lines intersecting at this point. This is known as an area of high confluence. When price approaches such an area, there is a greater likelihood of a reversal forming. However, it is important to remember that you should not blindly enter a position solely based on the price pulling back towards a level. Prices can still break through the level and continue moving upwards. That's why it is crucial to employ other confirmation techniques before entering a position. One of the confirmation techniques we can utilize is analyzing candlestick patterns. Let me provide you with an example. We have a current downtrend characterized by lower highs and lower lows. Additionally, we have the 50-period moving average acting as a key level, intersecting with a resistance line. This convergence creates an area of high confluence. As the price pulls back towards this confluence, you should observe if the price exhibits any form of rejection. In our case, we identified a bearish engulfing pattern, where the body of the second candle completely engulfs the previous candle. This pattern reveals that initially, buyers pushed the price up, forming a medium-sized green candle. However, sellers then intervened and pushed the price back down, even surpassing the opening price of the previous candle. This indicates significant selling pressure in this area. For a stronger confirmation, you can wait for the formation of the next candle, which turns out to be another substantial red candle. This presents a favorable opportunity to take a short position. Let's now illustrate this concept using another chart. But before we continue, please take just 2 seconds to support this channel by liking the video and subscribing. Your support means a lot and motivates me to create more valuable content. Join our community with 2 quick clicks, and let's embark on an exciting journey of learning and growth together. On the left side of the chart, we identified an area where the price faced resistance as it was rejected multiple times. Eventually, the price broke out of this resistance level and underwent a pullback. To confirm that the price will indeed reject this level and continue moving upwards, you need to observe if there is any form of rejection at this area. In our case, we observed a hammer candlestick, characterized by a bottom wick sticking out. This hammer candlestick indicates that sellers attempted to push the price down, even breaking the support level. However, buyers stepped in and pushed the price back up, signaling strong buying pressure at this key area. Furthermore, to reinforce the belief that the price will continue its upward trajectory, the subsequent candle after the hammer was a large green candle. This presents a favorable opportunity for a long entry. In summary, the crucial aspect here is to identify candlestick patterns that signal rejection. Let's proceed to the next topic. Another confirmation technique you can utilize is known as the break of a trendline. Here's how it works. In this chart, we observe a downtrend with a trendline drawn as our key level. As the price pulls back towards the trendline, we aim to confirm that the price will indeed reject this level and resume its downward movement. To do this, we can draw a smaller trendline right at the pullback. Once the price breaks out of this smaller trendline, that's when you should consider entering a sell position. Let's demonstrate this concept once again using another chart. Here's an example of an uptrend where we have a trendline position below it. Additionally, we noticed a resistance line intersecting at this point, creating an area of high confluence. To confirm or signal, you should wait for the price to break out of this smaller trend line. Once the breakout occurs, you can consider entering a buy position. However, it's essential to keep in mind that if you come across a setup where the trendline breakout technique is not suitable, don't force it. Let's now move on to the next topic. Another confirmation technique you can utilize is the RSI, or Relative Strength Index indicator. To implement this strategy, you need to adjust the RSI settings. Simply go to the indicator's settings and change both values to 50. This adjustment will create a single line in the middle of the indicator. Here's how the strategy works. Take a look at this chart with the RSI indicator applied. Observing the left side of the chart, we notice that the price rejected a certain level multiple times, indicating an area of resistance. Following that, the price broke out of the resistance and underwent a pullback. Now, the key is to determine whether the price will reject this level and resume its upward movement. To do this, wait for the RSI line to cross above the middle line. This crossover will present a favorable opportunity for a long entry. Let's illustrate this concept using another chart. In this scenario, we observe a downtrend with the RSI indicator applied. Furthermore, we notice that the price has consistently rejected the upper area, indicating a potential resistance level. To mark this level, we can draw a trend line above it. Additionally, there is a distinct support level that adds to the confluence in this area. As the price retraces back up to this level, our goal is to confirm that it will indeed reject this level and continue its downward movement. To achieve this confirmation, we patiently wait for the RSI line to cross below the middle line. Once this crossover occurs, it presents a favorable opportunity to enter a short position. So, I've just shared with you a simple pullback trading strategy that you can start using right away, because this is purely a price action strategy. But if you prefer, I have provided a trading system that can automatically assist you in quickly and accurately identifying confluence areas, as I am demonstrating here. With this trading system, you will never be bothered again in determining support and resistance areas. You also don't need to hassle with determining the current market trend line. So, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link in the description. As always, if you learned something new or if you want more videos more often, Make sure you subscribe, click the notification bell, and leave us a like to show your support. See you next time.